November hasn't started well for the markets. There's a lot of red out there, but interestingly, this recent pullback still hasn't shaken the bigger picture. Over the past year, so many stocks have run up at an alarming and honestly pretty unnatural rate. Even with the stock market sitting near all-time highs, investor sentiment is deep in the fear zone. Just a few days ago, we actually dipped into extreme fear territory, and that might not surprise you if you've seen how stretched valuations across the S&P have become. There aren't many green opportunities left out there, barely any real bargains in sight. So today we're not going to talk about stocks like Broadcom, which is up over 100% in the last year, or even Micron Tech, which is up an incredible 133%. Instead, we're turning our attention to the other side of the market, the hammered names, to find out whether they're genuine buying opportunities or value traps waiting to catch investors off guard. We're going to run through 10 very quick fire and looking at our own valuation as well. Number one is Starbucks, down 16% in the last year. Year to date, it's also down. Over the last 10 years, not great at all, up only 36%. You would have massively underperformed the S&P. And if you want to see all-time highs, you'd have to go to July more than 4 years ago at $126. And it's trading very near to 52-week lows. Huge pullback from their 52-week high. And the rating summary does give a traffic light system. Sell from Seek Alpha, very weak buy rating from Wall Street, 3.6 out of 5. And Quant do deem Starbucks today to be a hold. Now the forward P looks alarmingly high at 35. That is also well above the 5-year average of 29. So we're already kicking things off with stock number one, Starbucks, giving a potential overvaluation signal. If you did add mid-2024, the forward P was as low as around 17-18. But you may look at this and say yield 2.9% is above the 5-year average of 2.3, so actually a contradictory and possible undervaluation signal. But we do want to make you aware, if you're looking at this company for the yield of 3%, the actual safety of it does sit at 60 borderline safe, which isn't great. We're about to discuss why it's there, and their recent dividend increase just last month, very unnatural for this company, did sit at below inflation, 1.6%. Now safety does follow two different things. The first one, the free cash flow payout, where we want to note below 50% for the restaurant industry. Trailing 12 month, 123% for Starbucks. That is a massive red flag indicator. Anytime it sits above 100%, it's telling you that management are paying out more in dividends than they're generating in free cash flow. Also well above the maximum we want to see, and even over the next year, it's still expected to be very high at 92%. Where the other thing to consider is the net debt to EBITDA. We want below 3.5 for the restaurant industry. Again, correlates to dividend safety, but also the balance sheet strength. And the numbers you see below are the number of years it would take Starbucks to pay off all of their debt, and it's been increasing from 2021. Yes, it is still below 3.5 at 2.66, but you can see, couple this with the very high free cash flow payout, why Starbucks' dividend does look to be under fire. And if we also move on to the blue tunnel, which as always for the newer viewers highlights the intrinsic or fair price, we notice the company right now sits above the upper end, another potential overvaluation signal. Not great as well to see the blue tunnel decreasing over the last year. These aren't signs you want to see, and very surprising given this company has already been fairly hammered. And if we zoom out to the last 10 years, well, you can see this company has traded in many different cycles. One at a massive premium overall, another one, as we said, around 2024 at a discount, but now not looking good. From that 2024 beginning, intrinsically it's been coming down, and the share price now sits above the fair value. And if we look at the valuation grade, they get a D+. Forward P sits at a 110% premium to the sector, a 12% premium to their 5-year average. And if we look at the price to earnings growth, below 2 is what we always say does get us excited. 2.74 against the sector median at 1.7, you are paying a 62% premium. Interestingly though, their 5-year average PEG, price to earnings growth, sits at 3, meaning you are getting an 8.3% discount. And as we said, each one of these we're going to run through our own intrinsic value, for Starbucks coming to $71, the average of the 3 models that you see on screen, where typically we run through each one highlighting the inputs and the outputs. 10 stocks a day, we're going to be a bit quicker than usual, and at $71, we will flag that if you solely want to look at the discounted cash flow model, it comes to $59, where on a reverse DCF, 12.4% is baked in today. May already tell you this does look to be overvalued unless you can see them growing it quicker than 12.4%. In the model, we've used 8%, which on average, you're not getting a margin of safety, because for that, we'd want to see 10% at a bare minimum. We'd execute buy if it met the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. That would be a buy at $64. Today, the alarm bells are ringing. We're seeing this at a 19% premium, not something you would expect for a company like Starbucks that has already been hammered. But if you do want those price targets at a 10% MOS, a buy at $64, at 20%, a buy at $57, and at 25%, a buy at $53. Wall Street themselves do see upside. They actually believe this will be $95 within the next 12 months, 13% during that period. But let us know your views today. But is Starbucks today a buy, hold, or complete avoid? Now, before we move on to the next stock, we want to flag we have released our latest free weekly article covering 3 stocks to buy after the market pullback. We release one every single Sunday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is Nike, down 21% over the last year. Year to date down 19%. Over the last 10 years, well, this one is down 8%. If you'd invested $10,000 in this household name 10 years ago, you would have less money at this point in time. And we can see since their all-time highs, we're talking around 4 years ago at $180. This one has been ever since then trending downwards, and one we do typically cover when we look at poor companies in terms of their valuations, and it continues to fall, now sitting towards their 52-week lows with only 1 buy rating, and that is on the weaker side from Wall Street, a hold from both Seek Alpha as well as Quant. Now the forward PE sits at 32, not far off their 5-year average of 33, so based on this, potentially reasonably valued. Yield, very similar scenario to what we just noted from stock number 1, 2.6% above their 5-year average at 1.3, so this model could in fact highlight undervaluation. But dissimilar to the previous one, we do notice Starbucks had a borderline safe dividend score. Nike, on the other hand, does sit at safe, and the blue model here is in fact showing it in the middle, so we do notice again another reasonable potential signal. Although like Starbucks, we do see the expected fair price decreasing, not typically a great sign for a company you want to consider. And we can see over the last 10 years, the share price has moved very minimal when we look from start to end. Yes, it has gone up, peaked in 2022, but the intrinsic value has started to come crashing down. Again, something to consider. Where the valuation grade gets a D, 125% premium to the sector, a premium of 6% to their 5-year average, and price to earnings growth now sits around 2. Remember, that is what we said we want to see before we ultimately consider. Nonetheless, an 18% premium to the sector, but historically Nike was trading at a 4.2 PEG, so you are getting solely on this model a 52% discount. Now our intrinsic value gets to $62, where in isolation the DCF model comes there or thereabouts at around 60-61. We've used 8% moving forwards. That is ultimately roughly what is baked in today, so you could see support for that reasonable conclusion. However, when we do take a look, our intrinsic price at $62 does give you a margin of safety, very trivial at 2%. So like what we just noted, we believe the company now is trading at its fair price. Wall Street in complete disagreement. They see this at $85 into the next year. That it translates to 39% upside. Again, if you want a price target, 10%, a buy at $56, at 20, a buy at 50, and 25, 47. So let us know, stock number 2, whether you see this as a buy, hold, or complete avoid. We then move on to Zoetis, one we covered not that long ago, but for a video like today, definitely one that needs to be right in the center. Down 32% in the last year, down 27% year to date. Over the last 10 years, only by a small distance underperforming the S&P, but you can see their all-time highs 4 years ago, $244, trading right there at 52-week lows, and a buy rating from Wall Street. The other two giving it a hold. Wall Street respectable 4.2 out of 5, and forward P of 18.2, the lowest it's been in at least the last 5 years, historically 31, yield 1.7, above 5-year 0.9. Both of these indicating Zoetis potentially severely undervalued, and great to see dividend safety score sitting at 74, where the blue tunnel is showing signs of severe undervaluation. And what's good to see, unlike the previous two, the intrinsic price has remained fairly flat. Ultimately, we do want to see this grow, but given the fact it has remained flat, we are noticing the share price deviate to the lower end, indicating again, as we said, potential undervaluation. Over the last 10 years, still looking good. The blue tunnel is incrementally increasing over time. We notice, whilst it did peak in 2022, at that time anyway, it was trading at a massive premium, something we're seeing with a lot of companies if you've been following this channel for quite some time. Now it looks like Zoetis is giving investors a potential opportunity. Now D+ on the grading, where it pretty much trades in line with the sector today, a 44% discount to their 5-year average. Price to earnings growth doesn't look great. It is above 2 at 2.4, 25% premium to the sector. But actually against their own 5-year average, they were historically at the 3.2 level, so you are getting a 25% discount. And our intrinsic price at $156 today from the DCF is using a 10% growth rate moving forwards, but on a reverse basis, 6.5, which could straight away tell you there is opportunity, because whether you look at 8, 10 or 12%, each one is indicating double-digit growth. And as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Zoetis or any others. And don't forget, we do use the growth rate with the discount rate to give us the present value of future free cash flow and terminal price. Add together with the cash, subtract total debt to get to the equity value, divide by the shares outstanding, which does ultimately give us the intrinsic value. And using the middle rate, where we see 31% upside, for Zoetis today, you are getting a 24% MOS. If you wanted 30, well, a buy at $109, where Wall Street themselves see 175 into next year. That is 47% upside. From their eyes, a massive opportunity. Let us know if you agree or in fact do believe the complete opposite. Then we move on to Accenture, battered 32% in the last year. Year to date, pretty similar result. Over the last 10, underperformed the S&P a little bit, up 127. Quite a theme going on where it seems like these stocks we're covering so far peaked around 4 years ago. Accenture, very similar, trading at $415. Today though, right there around 52-week lows, and a double buy on the weaker side from both seeing alpha as well as Wall Street. One do give it a weak hold of 3 out of 5. Now forward P, 18, the lowest it's been in at least the last 5 years, with the average at 27, as well as a yield 2.7%, significantly above the 5-year of 1.5. Both indications today of severe undervaluation like we saw with Zoetis. Great to see as well, the dividend safety score does come in 92, very safe. They increased the dividend as well a couple of months ago at 10.1%, and the blue tunnel is also showing, again, very similar to what we saw with Zoetis. Intrinsically, no real movement, but the share price from around June has in fact been getting lower and lower, whilst ultimately the gap, the disparity here is getting significantly high, again leading us to question potential severe undervaluation, for which when we look at the last 10 years actually looks very good for Accenture. Intrinsically, the trajectory is very positive in climbing. We're seeing now, not for the first time, but very rare to see in fact, this company trading in a severely undervalued place, so maybe one in your view as a potential great opportunity. Now valuation at a B- against the sector, 27% discount, 37% discount to their 5-year average. Price to earnings growth now below 2, a 10% discount to the sector. 5-year quite high, meaning today on a price to earnings growth, Accenture is trading at a 31% discount to their 5-year average, and our intrinsic price at $324 does in fact use only a 2% growth rate. Baked in today is negative 2%. That is a decrease year on year to their future free cash flow, and if you were to use 10%, we're talking about more than a double at 134% gain, where the intrinsic price would come to $570. If you wanted to use 6, again very reasonable, $430, 76% upside. But let's be very conservative today, and this 2% does give rise to a 25% MOS. You want 30, well, buy at 226. Wall Street themselves see $288 into next year, 18% upside. So let us know your views on Accenture today. We then move on to the Kroger company, which is down 7% in the last 6 months. It's also down double digit from 52-week highs of $75, trading towards the lower end of the 52-week range. We get our first triple buy rating across the board, although each one is more on the weaker end, and we notice both forward P as well as the yield not too dissimilar from their 5-year averages, indicating a reasonable signal, and we get a 71 safe score in the dividend, where the blue tunnel also gives us a reasonable signal sitting bang there in the middle. You will notice that this one, for quite a large portion in the last 12 months, was trading at a premium and hasn't once traded in an undervaluation signal. Something, however, when we do zoom out to the last 10 years, Kroger has given many opportunities to investors to buy this severely undervalued, the most recent time at the beginning of 2024. And on a valuation grading, they get a C, 16% discount to the sector, 10% premium to the 5-year. Price to earnings growth, a little bit on the higher end at 2.1, although a 16% discount to the sector, that sits at 2.5, but their own 5-year does come in below 2 at 1.8, meaning on a price to earnings growth, you're paying an 18% premium. Now our intrinsic price gets to $76. DCF not too dissimilar at 75, where we've gone for a 10% growth rate moving forwards. Baked in is 8.5%, where you'll notice today, in totality, using these 3 models, you're getting a 16% margin of safety. At 20, a buy at 61, at 25, $57. Wall Street themselves see $82 into next year. We got the triple buy rating for the first time today, 28% projected upside. Is Kroger now a buy, hold, or complete avoid? We then move on to Costco, which is down around 2% in the last year. Year to date, it's pretty much flat, but quite a large pullback from their 52-week high, trading very near to 52-week lows, a rare occasion for this company, and just 1 buy rating, a hold from Seeking Alpha and Quant. Wall Street bang on 4 out of 5, and even trading near 52-week lows, we still notice in isolation and in combination with their 5-year average, it's sitting at 46, very high. We do get an overvaluation signal. If you want to see the lowest forward P of Costco in the last 5 years, well, around 2021 it was sitting just above 30, which you could also argue is very high. Yield is also at 0.6%, lower than historical 0.7%, and probably no surprises that we do see this overvaluation signal, although you'll notice from the beginning of the year, the price has started to come more and more in line with the reasonable signal. Still not there, even with the drop. Maybe we'll see this over the next few months. But zooming out to the last 10 years, again, you may not be surprised, but Costco is a company that hasn't traded in an undervaluation signal. It may not over the next 10 years, so if it does enter into the bottom end of a reasonable signal, we will let you know. So make sure you're subscribed and notification bell is in fact on. An evaluation grading of an F, meaning a 187 premium to the sector, 7% premium to their 5-year average. Price to earnings growth, a whopping 5.3, 108% premium to the sector. Their own 5-year very high, but nonetheless today even higher at a 21% premium. And our intrinsic value getting to $829, which you could argue is on the more optimistic side because we have a medium growth rate of 15%. Baked in today is 16.4. So on the 10 or 15%, you're still seeing downside. To truly see upside, you need to believe Costco will grow their future free cash flow 20% over the longer term, looking incredibly unrealistic. So even with the middle growth rate of 15%, there is no margin of safety today. You're actually looking at a 10% premium. 10% MOS would be at 746, 20 would be at 663, and 25,622. Wall Street do see 19% upside into the next year, $1,090 price target, but let us know where you sit on the Costco fence. We then move on to Diageo, down 21% in the last year, 24% year to date. Over the last 10 years, like a few today, you would in fact have less money than your investment from 10 years ago, trading very near to 52-week lows. We notice one buy rating incredibly weak from Wall Street, with a double hold from Seeking Alpha from Quant near the sell rating at 2.5, and this one's forward P, like others today, at a 5-year low at least at 14 with historical 20, yield above 4.2%, historical 2.2, so double potential severe undervaluation signal, and great to see their dividend safety sits at 90, very safe, and we also get an undervaluation signal below the bottom end of the blue tunnel, but actually intrinsically it has been edging lower and lower in the last 12 months. Something that if we zoom out to the last 10 years, this one in fact has been trading from around 2023 in an undervalued signal, whilst at the same time the fair price has also been decreasing. A very, very lethal combination. And the grading at a C, well, we can see against the sector, the company now trades at a 9% discount, a huge 34% discount to their 5-year average, and the price earnings growth 4.24, very, very high, a 68% premium to the sector. Now our intrinsic price 109, actually the DCF coming in lower at 96, where our growth rate is 8%, baked in is there or thereabouts at 7.8, telling us if you solely look at the discounted cash flow valuation, right now DEO does look at a fair price, but incorporating all three comes to $109, which as always you can grab a copy of this model by click on the pinned comment below. And if you did want a large MOS, well, 20% abide $87 at $25.82, and you can see Wall Street themselves 115 into next year, 21% upside. Is this a falling knife, or is now this a value play, a nice yield as well? Do give us your thoughts. We then move on to JD.com, down 20% in the last year, year to date down 9%, over the last 5 years also down 62%, trading very near, in fact, to its 52-week lows at $30. A strong buy from Wall Street, feels like the first time we've seen that today. Seeking Alpha 4.44, very near the 4.5, to also turn this into a strong buy. Quant though sticking firm with a hold, and the valuation grade gets a B+, 28% discount to the sector, 52% discount to their 5-year average. PEG though 2.4, that is a 42% premium to the sector and 114% premium to their 5-year. Now our intrinsic price gets to $44 in combination of all three models, solely on the DCF though much higher at $70, where in fact on a reverse DCF we see negative 15% to the future free cash flow. That could tell you already, if you don't mind buying companies here, then you are looking at very strong opportunity, because at a 0% growth rate, so no whatsoever to free cash flow growth, you are in fact seeing large MOS in combination 30%. Wall Street, as we saw, strong buy rating, $42 into next year, 35% upside, but let us know whether or not this one does particularly attract you. Then we move into Vici Properties, the REIT, down 3% over the last year. Year to date, this one is in fact up. Over the last 6 months though, it is in a downward trend on a pullback of around 10% from 52-week high. And not only do we get another triple buy across the board, but every single one is in fact near the strong buy rating. So if this one does come down, maybe $1 or $2, we could see a triple strong buy across the board. Now forward P to FFO, adjusted funds from operations, something used for REITs, 12.6, one of the lowest in the last 5 years, below 5-year average of 14.4, yield touching around the 6% point when historically it's been at 5. But we do have to flag the 50 borderline safe score on the dividend, and also reflect that in the last few months it did increase the dividend at 4%, pretty much in line with inflation. Now in terms of the borderline safe score, it's not really relevant to the AFFO because we want to see below 75%. That is very, very consistent, 74 on a trailing 12 month, expect the same in the next 12, but more to do with the net debt to EBITDA, where we want to see below 3.5 for this industry. And to be fair, it has been climbing down from the highs in 2022 at 6.46, but nonetheless 5.3 on a trailing 12 month is what gives this that borderline safe score. And having said all of that, we do notice slightly below the bottom end of the blue tunnel. We've noticed it once or twice in the last 12, leading to a potential undervaluation signal. One that over the last 10 years, when we do in fact zoom out, we do see this one not that often trading an undervaluation, although like most companies during the COVID drop, it did look like a great bargain, trading around $11, and their valuation grading, they get a B+. If we look at the P to FFO on a forward basis, 12.9, this one is trading at a 16% discount to the sector overall, which our intrinsic price gets to $38.75, leading to a 21% MOS, very attractive starting yield as well if you do want companies in this industry. At 25, a buy at 29, and Wall Street themselves with a near triple strong buy across the board, $36 into next year, 18% upside. But let us know your views on Vici Properties. And then we move on to Air Products and Chemicals, down 18% in the last year, 10% year to date. Over the last 10, up 86, so you would have underperformed the S&P, trading near 52-week low. Double buy rating, although weak one from Seeking Alpha, fairly respectable from Wall Street, and the forward P around 20 is below the average of 23. Yield a little bit higher, 2.8 versus 2.5, but good to see, quite common today actually, a very safe dividend score of 95, and also an undervaluation signal on the blue tunnel. We've noticed this once before during Liberation Day in the last 12 months, for which when we zoom out to the last 10 years, for the large part, fair value has been increasing in the direction we want to see with the consistency, and you'll notice in the beginning of 2024 a massive severe undervaluation signal, not something we've seen that much in the last 10, so maybe now potential opportunity. And the grading, you get a C- here, in fact trading 25% premium to the sector but 21% discount to the 5-year, which is always the more useful information. Price to earnings growth 2.4, high in isolation, 87% premium to the sector, but a very small 5% discount to their historical. And our intrinsic price, $333, the average of the two, does give rise to a 23% MOS, 25 a buy at 250, and at 30%, 233. Wall Street see $313 into next year, 21% upside. Let us know, Air Products and Chemicals, buy, hold, or avoid. And don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.